In this video, I want to discuss how to invest in a high volatility markets, kind of revealing strategies for success, in this market condition. Investing in high volatility markets where stock prices experience large and frequent swings requires a careful approach to managing, risk and to capitalize on opportunities. So here is how to effectively invest in such a market condition. Number one is focus on risk management. That should be a priority. You focus on how to manage your risk inherently attached to high volatility markets. So in this case, you consider position sizing. So limit the size of individual investments to reduce exposure to any one position, helping to manage potential losses during volatile swing. You have a considerable exposure to stocks, so you tend to size your positions, in smaller sizes. You allocate smaller sizes of capital to a wider number of stocks, as the case may be. So you equally have, stop loss order. You can incorporate stop loss orders. So use stop loss orders to protect your investment by automatically selling a security if it drops to a predetermined price. If your stop loss is $2, once the stock drops down to $2, the system is designed to sell the stocks automatically to mitigate your risks and to curtail, further losses as a result of dropping prices. You equally have diversification. So you spread investment across various asset classes, across sectors, regions, so as to be able to reduce your overall portfolio risk. Number two is embrace safe haven assets. Embrace, safe haven assets. In this case, you may consider gold and precious metals. So consider investing in gold or other precious metals, which often performs well during periods of high volatility. As investors seek safety, it performs. The performance don't correlate with stocks, during a high volatility market. You equally consider government bonds. Allocate parts of your portfolio to high quality government bonds, which are typically seen as safer investments during market turbulence. You have number three here is consider hedging strategies. So under hedging, you may equally make use of inverse ETFs. So allocate part of your portfolio to high quality exchange traded funds that move in opposite direction to their benchmark, allowing you to profit from or hedge against market decline. So in this case, when the benchmark is doing very well, your ETF might perform poorly. And when the benchmark does poorly, your ETF performs, excellently. So that's what is called inverse ETF. So option trading is not for everybody; it's for the skilled, investors. So use employ option strategies such as protective puts to hedge against potential losses in your stock holdings. When it comes to option, my country we don't have opportunity for options trading. It's not available in our markets. Number five is focus on high quality stocks. You focus on high quality stocks. So strong fundamentals are very, very important. So invest in companies with strong balance sheets, consistent earning and solid management, as they are more likely to withstand market volatility. You also consider blue chip stocks. So consider blue chip stocks with a history of stability and performance, which may offer some protection during turbulent times. Number five is use dollar dollar cost averaging. So in this case, you invest regularly. So continue to invest a fixed amount of money at regular intervals, regardless of market conditions. So this strategy helps to average out the purchase price over time and reduce impact on volatility. It may be either monthly or quarterly or biannually. Just invest regularly. It's a very good strategy, particularly in a high volatile environment. Number number Still under number 5, you have long-term focus. So when you dollar cost averaging encourages a long-term perspective, helping you to stay invested during market downturn. You have that long-term perspective, that long-term horizon. So you're not really affected by short-term volatility because you are looking at the bigger picture, looking at the future, with the fact that all things being equal, stocks will recover and perform very well in the future over the long term. Not only that, you have number 6, you monitor market sentiments. So in this case, you consider the volatility index, the VIX. So you keep an eye on the VIX, often referred to as fear factors or the fear index, which measures market volatility levels, and it may indicate extreme fear and potential buying opportunities. You also take into consideration investor sentiment. Stay informed about investor sentiments and market psychology. As extreme optimism or pessimism, signals are turning points in the markets. When you get to those extremes, that indicates that the market is about to undertake or has reached a turning point. Number 7 is take advantage of short-term trading opportunities. Take advantage of short-term trading opportunities. In this case, you may consider swing trading. Consider short-term trading strategies like swing trading, which capitalizes on market swings, within a volatile environment. When the market swings in your favor, swings higher, you may decide to sell your stocks to, lock in profits. You may equally consider scalping. So scalping is for experienced traders. Scalping involves making quick, small profits, on numerous, trades throughout the day, taking advantage of market fluctuation. This is strategy is usually adopted by professional traders. Please like this video and subscribe to this channel if you've not done that. Number 8 is maintain cash reserve. Maintain cash reserve. This has to do with liquidity. Keep a portion of your portfolio in cash or cash equivalents, giving you the flexibility to take advantage of opportunities when they arise, or to avoid further losses. Usually in a market like this, you always come across opportunities. So if you have sufficient cash, you can buy low and sell high. And it's very important you have sufficient cash in your portfolio so that you not even end up selling at a loss because you want to raise cash. Part of number 8 is opportunity fund. So use your cash reserves to buy into the market when prices are low, potentially boosting your returns when the market stabilizes. I've earlier explained that when you maintain that cash balance, whenever there's an opportunity, the market, a particular stock is selling at a sufficiently low price, you can key into the stock, and when it rises, you make gains. Number 9 is stay informed and adaptable. Stay informed and adaptable. In this case, you consider economic indicators. Keep up with economic data, corporate earning reports, and global events that could influence market volatility. Not only that, you adapt your strategy. Be prepared to adjust your investment strategy based on changing market conditions, balancing risk and opportunity as needed. So you learn to adapt, based on the prevailing market condition. Don't be so rigid, be flexible, because flexibility brings profitability. Number 10 is practice patience and discipline. You practice, staying patient, and also you discipline yourself. So avoid panic selling. Resist the urge to sell investments, in a panic during volatile times. Instead, focus on your long-term investment goals. Be long-term oriented, because volatility will not last forever. The markets will recover, will become stable as expected, and then you focus on your long-term goal as an investor. Number 10 is still, you stick to your plan. You must invest with a plan, invest with a strategy, invest based on, your individual principles. So maintain discipline in following your investment strategy, even when the market is unpredictable. So in summary, investing in high volatility market requires a strong focus on risk management, diversification, and identifying, a safe haven assets. So employing, hedging strategies, maintaining cash reserve, and staying informed about market sentiments can help you navigate market turbulence. Not only that, you know, you consider short-term trading opportunities for additional gains, but also prioritize patience and discipline to avoid making impulsive decisions. By adopting these strategies, you can better manage the challenges of high volatility markets and position yourself and your portfolio for success, in the long term.